So this panel discussion is on product diversification and development. So actually quite timely given the last bit of commentary. What are the emerging business models within microfinance, financial inclusion and beyond? Can MFIs play an important role with delivering additional services, housing, education, insurance, energy, and what is needed in order to create a meaningful social value? And how are mobile and digital technologies shaping the industry? So I think what would be great, and I'm going to start at the end, Steve, with you, given your previous life and sort of where you are now, to talk about maybe some of the successes and failures that you've seen in distributing additional products through the very traditional microfinance distribution channel, and what we've learned through that engagement process, and sort of what we should be taking with us as we think about new models.
Great, thanks, Dani. I think you're probably referring to my time at Freedom from Hunger, right? I was, before being president of Grameen Foundation, I was president of Freedom from Hunger. And I think it was quite well known for what was called value-added microfinance or integrated microfinance. And, the thing that occurs, to me is that oftentimes we discuss kind of the activity of microfinance without necessarily focusing enough on the kind of outcome that we want to derive from it. And if we start from the kind of human outcome that we want to derive from microfinance, it raises, I think, a whole other set of issues other than just, your collection rates and your return on investment, et cetera. So, I think one of the experiences, of course, from the Freedom Hunger days was that microfinance institutions that really were very true to a social value, social impact, very true to training their field staff, which is probably one of the biggest indicators that we found in terms of their ability of microfinance institutions to affect a true kind of social change on their client. They were very interested in pursuing other kinds of interventions, credit plus, education, credit plus healthcare, credit plus, support to agriculture, graduation programs for, very poor clients. And you would see them evolving business models and ways of investing that really drove that work, right? So it wasn't just a financial transaction or proposition to a client. It was really trying to understand, how to address the underlying kind of needs of poverty. So within the universe of microfinance entities, I think sadly that doesn't capture all of the groups in it. There's a real divide in our industry about, I think, those MFIs that really are seeking that and using their revenue and their investment capital to do just that. Freedom from Hunger had a lot of success with integrating non-formal education with microfinance with those appropriate MFIs. It had tremendous success and still really does now in the integrated Grameen. Freedom from Hunger has come with me to Grameen Foundation, which is a wonderful thing. And, it's also had a lot of success in integrating health financing and access to health services through the traditional microfinance chain. So I hope that addressed some of the issues.
So if Mumina, maybe you could dive in here to sort of talk about what you've seen through various, I would imagine, investments you've made or endeavors. What's been successful?
Thank you. So I was smiling because we just seen something in India where we had partnered with an institution which was selling solar cook stoves. And I think just to pick up on the last panel, distribution, but also product placement and the quality of the product is just so important because, here you had like an MFI, which was doing really well, had, very effective client base, client servicing, etc. And the moment they got into this product, they ended up with, post-sale service was terrible. The product itself, though, was cheap, was not doing well, and they suddenly ended up, completely, the brand was getting destroyed by this. They were ending up with thousands of these cook stoves in the branches, which nobody knew what to do with because they didn't work. They were $20, $30 cook stoves, and it completely changed the brand that they had built up over, the last 20 years. It changed the, the loan product. The loan officers were not happy, the clients were not happy. And so it's very important to get these things right when you are going into, and I know there's a push, from donors and impact investors on developing these new spaces, whether it's renewable energy. I mean, we hear the same thing on insurance products and housing, and, lending to women. But it's very important to get that essential product right. And also for MFIs to be responsible enough to recognize what is right and what is not. So they may have the distribution network to be able to service those clients, but really, is it their role? I mean, I think in places like India, regulators are realizing that, the MFIs should stick to their basic knitting and focus on these, the key financial services products, and whether they have actually partnered with the right entity in order to do so.
So I find it deeply ironic that the microfinance industry, with its recent history with impact evaluations, would then expand into something that has an even worse record on the impact evaluation front as a way of expanding their things. If there's any sector that's attracted a lot of attention that has vastly more evidence of no effect, it's cook stoves. So maybe that's one place to look at how you think about what you're expanding into, is not into the things that have even worse records than you do.
Although one thing I would add on the cook stoves, not that we want to get derailed on cook stoves,
Right.
the evidence so far is poor, and I think this is consistent with some of the evidence on financial products as well, in services as well. It's not necessarily that because some of this initial evidence was negative that this is kind of a dead end and there's no hope to it, but with the cook stoves, I think a lot of the insights are that they break and then there's no access to, appropriate repairs in the community. And so there you have to kind of take more of an ecosystem look to thinking about cook stoves, which in principle and in a lab are effective at improving health outcomes. You could potentially build those into a distribution network run by MFIs, but it does then make the MFI responsible for thinking about how it's also going to consider all of these other, necessary implications to actually make the cook stoves work. So there hasn't been an impact evaluation there, but I think there's potential for an improved approach to cook stoves to actually lead to some of those health outcomes.
I really hope that. It's just that we've been saying that for 30 years now.
Yeah.
That at some point you might want to, maybe we just don't really understand this.
But it's the same with rural finance or education or any of these new products, right? One really has to understand the intrinsic product, whether it's an insurance product or a rural finance, an agri product. I mean, one has to understand the intrinsic risks of that industry before developing the product.
Absolutely. I mean, I would say in many ways, credit is the easiest financial product.
Yep.
And there's a reason that that's the thing that really exploded, is because it's actually the easiest thing to do. It's the easiest thing to regulate. And moving into savings and insurance and more complex, it's a lot harder.
Would you say that the emergence of non-bank financing companies and sort of specialty lending has been a good shift, or what, to be able to deliver some of these products versus microfinance institutions? And how do you think those two universe or parallel players in the market sort of serve one another or compete with one another as they target the same customer base? I mean, I leave that, and Tim or Jose, if you would like to answer.
Let me before that. I had a question for Damian and Sanjay. Imagine that you get to this wonderful MFI that says, in addition to microfinance, we have all sorts of other businesses. Leave aside what the regulator would say. In most Latin American countries where microfinance has developed very well, if you are a financial institution that is regulated, the regulator will say only finance. Everything else is out of the table. But suppose that the rating agencies come in and they see that in addition to microfinance, there are all sorts of other business lines. I think the first reaction is, where is your track record? Where have you succeeded? How is it that you're doing not just finance, but also all sorts of other activities, other services? So it seems to me that we have to distinguish between aspiration and temptation, because here we have something that has reached that bottom of the pyramid, and reality. And reality is that a financial institution traditionally is, at best, a catalyst. But every time that they try to do something which is not financial service, all sorts of things happen. And we have seen, we have actually seen microfinance groups try to do many, many things and do them fast. And typically, there is a derailment somewhere.
Well, I guess one aspect which is really taking off is the payment space, right? And that's very different from the traditional credit product, and that's why the introduction of these new fintechs or technology providers is really changing the landscape in some of these markets. Especially the potential for partnerships. When one thinks of Bangladesh and Bcash and how it's completely changed the whole market, and it's very much at the base of the pyramid. They're doing $20 payments all over the country. It's become a verb in Bangladesh. That's the power that it has to actually change the nature of the kind of services that are being offered. I think that's why technology's played a huge role.
I think there are kind of two realities that I would really point to. One is the reality of the very traditional Bangladeshi type of MFI, and what many of them have done is use profits maybe from their core banking work to support CSR activities that won't be regulated, that address the broader community needs. Groups like Bandan, or that's what they've done, right? I think the second reality that we're seeing is how financial services are a catalyst, but essentially through more digitized kind of systems where there are bundles of services that are being offered in agriculture or in health and things like that. So the financial service provider is able to stay in their lane. They're able to assess the kinds of market partnerships that may be valuable to their clients. And you can create essentially more of a networked approach, servicing clients. But I still think that the role of a financial service provider as a catalyst, particularly as we're looking to the future of mobile money, is going to be very important. They're going to be a central actor in, I think, many of these kind of service or product network markets.
Yeah, there's 6 billion smartphones expected by 2020. 6 billion smartphones.
Yeah.
So people are expected to have about 6 billion smartphones by 2020. And then if you look at the 2 billion who are unbanked, or, the 200 million MSMEs who don't have access to credit, that's a huge, potential, right, for mobile operators to be able to offer those services.
Very true. Go ahead.
I think as we discuss the issues of microfinance being able to deliver, being the channel to deliver other things, there are a couple of realities that I think we're dealing with. First of all, cross-selling is one of the most difficult challenges anywhere. And that is, of course, also true in this area. The second one is, I think we're also underlying what we're discussing, is what are key success factors of business aimed at the sort of 70% of the majority of the people that lie below the 20% well-served and the 10% that can't afford to buy anything because they're close to indigence. And Timothy, I think the question is not microfinance was the easiest. The question is, why was it the quote-unquote easiest? And part of the reason is because microfinance was a response to something that people already engaged in because they had to finance whatever their activity was. And it was a much better alternative even when it came at 150% interest rate because the existing alternative was so much worse. And in all the things that we're beginning to discuss, I think it's really important to have the point of view of the client that you're going to deliver things to. And perhaps one of the issues of cooking stoves, we may debate its impact, social impact, whatever. But the first one is, was this a product that we in the US thought it was great for people to have, or was it that people woke up and said, gee, I wish I had a different stove? And the same thing is true of preventive healthcare. It's true of a whole bunch of other things that may have great social benefit. But if you want to deal with it on a commercial platform, which of course microfinance is, you have to deal with the realities of why business succeed when they succeed or fail when they fail, when they try to address this. And if you disregard that, even if you can overcome cross-selling, which is a huge difficulty, you'll also fail.
All right. Ira, did you want to?
Yeah, I'm going to add. I assumed from observation post to CGAP as the industry began to commercialize, and then in writings that I've done on the commercialization, evolution of microfinance, and from board seats of institutions that are trying to work with Alex running a fund for higher education, and Renee now working very hard on water and solar energy. I assume that when microfinance institutions reach 100,000 clients or 50,000 clients, some now with several million clients, and with a strong savings base, they would be naturally able to extend financial services. And what's happened is that assumption, I think, is proven wrong. And I think anecdotally, we know that microinsurance, education, all these diverse areas of financial services maybe amount to 10 or 15% of portfolio, even for the best of microfinance institutions. So why is that the case? And actually, the real question is, are large-scale sustainable MFIs going to be the vehicles upon which you can do more diverse products and impact investing? And to finish it, one of the things we did in microfinance early on, we built infrastructure. Namely, I was involved in the first product that became the mix. And we began to benchmark microfinance institutions. Bob Christian did that for us on contract, and then we built out the mix. We have almost no information that I'm aware of in the industry on diverse products. I've seen nothing published, I've seen no data, and I've seen no mixed survey information on what percentage of portfolio, except savings, and you have rudimentary stuff on savings. It seems to me one of the first things you start with is gathering information. But my question to this panel is, do we really see large MFIs as the long-term vehicles for diverse financial product service delivery, and then also bridging into cross-selling and bringing other products? It seemed to me to be a natural, but it just isn't happening.
No, thank you for that clarification. I'd say, as you think about responding as panelists, because I'm going to push this off to you, in your response, it would be good to understand where you've seen success, if you have seen this. Because I haven't, so.
I would say, back to Michael's comments, I think we agree on the broad things, while disagreeing potentially a lot on the details. I would come back to when the microfinance industry launched. It wasn't that we thought lots of people had access to credit, it was just bad, and we're going to give them better product. The narrative was there's no access to credit. I'm saying, yes, there absolutely was, but that wasn't why what the narrative was, what we were thinking. It was that we're introducing access to credit to people who have been denied access, and I think people are using a lot of, I think people have, right.
Okay.
So let's come back to the question of, has there been success? And I think that one of the areas that Michael and I really agree is the presumption of success sort of overlooks the fact that financial institutions are good at doing finance. They're not necessarily good at doing other things.
Yes,
And
servicing.
we shouldn't expect that there are a lot of successes, because the places where there are going to be promised innovations aren't in adding on different products that are from completely different industries. If we look at the way industries evolve, you don't get much other than finance from a financial institution anywhere else in the world. Why should we expect that the financial institutions in low-income countries are going to deliver cars or other products? Where I do think we see some success is where you innovate the actual financial product, where you change the terms of the loan.
To finance.
Right. It's doing the basics of delivering financial services, and you in some sense you really shouldn't care what the customer is buying with the money you lend them. Right. So just make sure that you're structuring loans in different ways. You know, the vehicle loan in a developed country isn't really about the vehicle. It's about a structured loan that accords with the thing that the customer wants to buy. It's not the giving them a car. And I think that's where we start to see success is agricultural loans, consumption smoothing loans, savings product commitment, savings products, and those sorts of things. And I don't think we should expect to see much success in people going into completely different industries they don't understand.
But Tim, financing cook serves, not the cook serves, but financing those.
But
Purchase of.
it's a consumer product loan. Just finance purchases, not finance cook stoves. Why do you care what they buy?
Maybe with the exception that you, not disagreeing, but the fact that you should care if you're really looking at the cash flow coming out of the loan you're making. If you, I mean, it's about the way you underwrite it. If you are, financing a productive asset, and that asset is going to produce a cash flow which will then underwrite the loan that you're making. Not disagreeing, just clarifying.
Yeah, no, I totally agree. And you're talking about an investment loan and not a consumption loan, right? It's still underwriting, but it's what you're underwriting on.
I think there are very significant examples where there have been successes of MFIs, offering other products, linking with service providers. The biggest one that I know of is the work that Freedom Hunger did in health, for example. Very successful. It was able to understand the gaps in terms of health access and provide a finance bridge from an MFI that smoothed, the access that very poor people had to clinics and things like that. From the point of view maybe of a profitable product line for a large successful MFI, it's not nearly going to be as successful as microloans, right? From the point of view of pretty significant numbers of people getting access to health care, you're talking 800, 900,000 with CARD and Bondon and groups like that, very successful. So it can be done, but to me, it is important that the financial service providers stay in their lane about finance, but they become better brokers for the services or products that may be brought into their network, right? I think the other big thing that really is very significant is, microfinance really began with the idea that it needed to be replicable, scalable, and pretty much cookie cutter in its approach. And frankly, the big thing that's happening in our sector now is, we're able to understand our clients from a much more nuanced perspective, and we have to, right? And that's going to raise a lot of other types of business models, not only for the MFIs that are thinking it through, but also for, new entrants coming in, MFIs that only do agricultural loans in a specific value chain, MFIs that only do, maybe better than previous ones, cook stove, just for cook stoves, and certainly where there's mobile money piping in a country to allow that, Kenya is a great example. You're seeing, all kinds of different business models emerging around, the M-Pesa platform, and the success of it is going to be data. How you push data out to educate people or to inform your field workers, how you bring data in to have a more nuanced understanding of your client and what they need, right? So I think the big change that's going to... Sorry?
We have no data.
Well, who's we, I guess, is the the microfinance industry?
I think the microfinance industry does not have the data, but the telcos have much more data than the microfinance industry, and so you should not think that you will use. I think that microfinance has been too much egocentric, thinking that they are in the center of everything. They are at the center of very little things right now. And if they are clear enough of what they have achieved and why they will need others to achieve the next step of where they want to go, then they will be able to use the fintechs to achieve the next round of what they want to achieve. I think that data is out there. You can, by processing how people use their airtime, how people pay their bills using their cell phones, you can really predict quite a lot of behavior of those clients, and therefore be able to figure out the kind of financial services that they need. So we can think it as a competition between microfinance and the rest of the world, or we can think of a strategic alliance between microfinance and the microfinance clients with technology-based companies, and do scale access to what the services that are really needed to transform the life of the poor, using technology, which is the greatest enabler of this moment, I think.
Yeah, I just actually wanted to pick up on that point because I was in China last week, and we've been having these discussions with Ant Financial, which is the financial services arm of Alibaba Group. And they've just recently bought into one of our clients, CFPA, which is the largest microfinance entity in China. And, the conversation changes very dramatically when you realize that the CFPA, has 20 years of data on their clients. They just don't know how to use it. And now you suddenly partner with an entity like Ant, which has about 680 data points, which they can easily use that technology to understand your client base better. And it's, it's very interesting to see how that marriage could actually produce much better products because you just understand your clients better. Just even really simple things like one of the things they were sharing was that they could tell that the people who were higher credit risks were men who were applying between midnight and 6 in.the morning, clearly, because it's a post-bar loan.
Bad time to tweet.
But the fact that they could, clearly a consumption loan, but the fact that they had that kind of data available and you could link whatever was available on your smartphone with your traditional cash flow based lending models, so that could have a very powerful impact on how your traditional microfinance is being delivered. And that's frankly a very exciting opportunity because it can help reduce the costs but also change the nature of how you are perceiving even the risk of that loan, because you can actually have a much better risk profile in terms of offering the product.
Maybe just elaborating on that and coming from a different angle. In the previous, panel, we were talking, or we concluded maybe that microfinance is not dead; it's just evolving. And the question really would be evolving into what and how. And that's a good example. Maybe another way of looking at it would be. And the comment was also made that commercial players, those who do not come from an NGO origin, transforming into a bank or something like that, not mission-driven, the comment was made that maybe there would be fringe players. And maybe that is true for the very small new entrants in some countries. But I just want to really bring to the attention the fact that another way of looking at this would be commercial players that are not new entries, but rather have been there for much longer than microfinance. That is the commercial universal banks that are now really moving into microfinance in a big way. And I realize that's not true in every country, but certainly in enough countries to be taken very seriously. In countries like Peru, one bank has 1/3 of the market. One commercial bank has really moved into in a big way. And it really has disturbed the whole market. Same thing is in a different angle. It's true in Ecuador, in which the largest commercial bank in the country now has 15% of its portfolio composed of microfinance assets. So for them, it's a very important asset. And it's just putting things in context that things are changing very rapidly because of either technology or like you were saying, marriages of that
Acquisition.
kind, or commercial players moving in?
Yeah, no, I mean, I'm thinking of IFC. I mean, we have about 200 odd microfinance clients, but we have about 900 banking relationships. And the kinds of conversations we're having now with microfinance, I mean, players interested in microfinance is really across the board. I mean, it's banks, commercial entities, telcos, consumer goods providers, insurance companies like AXA. I mean, there's a huge interest in being able to access this base of the pyramid space. And they also realize that the microfinance sector has been able to, to some extent, reach those people successfully. It has reached scale and things. So, those conversations are rapidly changing from, microcredit being this do-good, so, the fact that you are providing the first-time loan to being able to offer this suite of products. So I think it's an opportunity as well for the microfinance sector to realize that they do have this strength, to be able to reach players at the base of the pyramid, and how do you leverage that to be able to offer, better, cheaper products?
So maybe I need a point of clarification, because in my mind, I think of a microfinance as a true sort of traditional model that's lending to the individual or to a group. And now we're starting to see a lot more emergence of specialty finance companies that are doing very specific product lending to sort of two-wheeler finance programs for, in India or across LATAM. Where do you see some of these models coexisting with a traditional microfinance? Because they're targeting the same customer base, but it's not the same model. And then taking that a little bit further, as we've learned what this customer base is and how they've evolved as individuals, as consumers, some of them have become micro entrepreneurs or MSMEs. And so as we think about lending to that segment or those needs as they expand themselves, how do we sort of see those specialty lending platforms play alongside with a traditional microfinance? Because I don't think a microfinance can do all of those, provide all of those services.
I can speak from the experience of Green Foundation in technology-enabled agricultural work. What we're finding in some countries, it may be that a buyer, wants to have visibility on the source, and they want to have tracing of the source of the product. It may be for organic or fair trade certification. There may be a variety of reasons why they want that, right? And they're able to put together a network that relies on mobile enablement to get that data, right? But from that data, they're also able to understand their other requirements, like finance, like visibility on pests and disease, right? And so they may be the catalyst for a network that relies on an MFI or a bank coming into it and providing the service to farmers. In other markets, it may be the agricultural lending, a group that we're a part owner of called Musoni in East Africa, for example, is an a mobile ag lending group. And, it started the premise, but has brought in buyers and market information and extension expertise in it. So, I think the flexibility of the model is very varied, right? But the core of it is, that there are these market linkages that are enabled by data and finance, essentially. So, the other really critical element in the bundle is what happens with your field staff, right? And how are they, instruments of support of the technology use to clients? How do they get access to the right kind of technical support via their mobile device or smartphone, to support the farmer? How can they be the front end and a more agile front end for the business partners to understand credit risk or understand climate risk or crop failure, what have you? And so, I think what's coming is this more kind of networked effort that MFIs, traditional MFIs, are going to have to think basically about how they engage in that and what is their role in that. And we see that definitely happening in agriculture pretty widely. It's definitely coming in healthcare, right? And there are probably some much bigger areas too that's going to happen in.
But also for traditional MFIs, I mean, you have to have your basics right. I mean, I'm thinking about the Morocco microfinance crisis. I mean, and there they were even going into, larger loans. And unless you have the right governance systems, the risk management systems, people who really understand the type of risk that you are trying to get into, and agri and healthcare are not easy sectors. I mean, you really need to have that internal capacity to be able to be sustainable, offer those products, and then scale them up.
I think the basics are just fundamental. For example, if you're underwriting loans of, working capital loans of 12 months or less, do you understand how to underwrite an agricultural loan that has a different timing cycle, or an equipment loan, or trade finance? So ultimately, especially if we move up to SMEs, they need a heterogeneous mix of finance. Do you know how to underwrite it? If all your incentives for your field staff are based on lending and collecting, the model of microfinance is a cookie cutter by now. They know how to do it. How do you adjust your incentive systems? Are your MIS systems, can you do MIS systems by product line, by division? When the social services institutions like CARE, like Freedom from Hunger, all of the faith-based groups went into microfinance. One of the first things we told them from CGAP is separate that business from your grant-based business, because you want to collect on those loans. You really have to keep your books and your MIS system well and know what your microfinance is doing. So if you're going into agricultural lending, if you're going into energy, you have to have a good MIS system and have good accounting by divisions or product line. So do you know how to market? If you want to market energy or irrigation or education loans, very different markets potentially. How do you market? So I think that's where the large MFIs are ill-equipped. They've been doing cookie cutter loans for so long, and they're doing very well at that, and they gave a great service. But just in finance, I'm not talking about other products, just in education, finance, healthcare, finance, that they are not equipped, and it gets down to basics and fundamentals. That's where I'm surprised we haven't seen more adaptation. And when Sanjay talked about Bangladesh not adapting, that's what hit me. Where's the innovation coming from? Where is there a push? Do we have the data on who's succeeding, who's not? Are there cases? That's what we had a lot of in the early part of microfinance.
I think on the kind of cookie cutter model, I think we know that it is scalable. We know that it can be profitable, but we also know that the kind of on average development impact of that model is not negative, but it's also not really extraordinarily positive. So from an impact investing perspective, maybe fine to continue investing in it, but if the interest really is in how to leverage this product to lead to a greater development impact, I think this kind of networked approach to thinking about how you actually can build on the vehicle of the sort of core MFI to tailor the product is really sort of the way of the future. And a lot of the evidence that we've seen from randomized evaluations of these things is that it's the modified products and the sort of credit contracts that are more tailored to the needs of a specific type of borrower, the case of the person who needs the two-wheeler, tend to have a greater impact. So I think it really is about figuring out how to tailor the contract design. In agricultural credit, there's some interesting evidence coming out about using asset collateralized loans offered by dairy cooperatives that are leading to increased production and girls spending more time in school and less time fetching water. And so this is not a super conventional product, but if there are ways that these kind of smaller dairy cooperatives that are figuring out how to do this can partner with the MFIs that have the bigger infrastructure, there's certainly a lot of potential there. So I think just focusing very much on the modified contract and tailoring the product design is where there at least is an evidence base to suggest that it can be more effective.
I keep hearing that the microfinance institution is the one that should do it. And the traditional way is to get the bank to finance the company or the person that knows the business. what we are talking about here is we want to extract data and get to know a business. Let's do it the other way. Let's try to find who is already knowledgeable and doing it, and perhaps find someone who can help that person to structure a new business that reaches the bottom of the pyramid.
That's saying that the microfinance institution isn't necessarily the provider of a lot of these diversified products. Is that isn't the base? Like, it could be an add-on, or your loan officer base isn't going to, on the traditional microfinance channel, is not going to be equipped to sell a two-wheeler product.
I'd go back to what Steve said, is that it depends on the institution. Some institutions have invested heavily in their field staff, and a lot of institutions haven't. And so an institution that hasn't invested in its field staff and doesn't have them well trained, and no, they're not going to do a good job selling a totally different product. An institution that has views the field staff as part of its development mission and has done a lot of investment in those people is likely to have people who might be able to sell other things. And so, as we talked about, this is an incredibly diverse industry. Saying it's going to be like this is, we need to know a lot more about the institution that you're talking about, and particularly what they've done at that last mile in terms of their field staff before we draw conclusions about what they will or will not be able to do.
Yeah, and so much of it depends on capacity, right? I mean, there's been this whole push to go into digital and develop channels, and we're talking to hundreds of these traditional MFIs who think that, by using technology, they'll have to go out and buy these MIS systems and train all their loan officers, to be digital agents and develop these partnerships. And it's a very expensive exercise. It's not one that a lot of institutions can absorb the cost of. So, in some of those cases, you have to have partnerships, because otherwise it just completely changes your business model. So it really has to be thought through carefully.
So I work for Finca. I am new to the microfinance space. I just started at Finca last year. So, and I caveat all of this stuff just because when I look at your backgrounds, you clearly have worked in the space for a very, very long time. And I've actually joined Finca to help them think through all of these sorts of questions. As importantly, I sit at Finca International, which is the 501c3, not the micro finance holding company, which is now Finca Impact Finance. But so we're wrestling with all of these questions that you're bringing up, and we're trying to figure out how we actually best intervene and innovate without being, and the goal is to be a partner and not a distraction, right, for our core competencies. And so the way that we're thinking about this is to say, look, as Finca International and helping build these businesses that are now deposit-taking banking institutions in their markets, we have material amount of experience and hopefully competencies. How do we leverage them in order to help support the businesses that will enable us to achieve our vision, which is helping people progress out of poverty? Access to finance is necessary, but it's not sufficient. We have things that we can bring to the table that can accelerate, hopefully, companies that are doing these things. Another insight from our side is that access to education, energy, healthcare, all of these things are, somebody said, assets or investments. And so, in fact, access to finance underpins meaningful access to those things. And so what is our role? We'll talk about this in my panel a little bit more, where I'll try to represent the microfinance side as effectively as possible. So they're undertaking a whole set of initiatives to become more accessible, more affordable, more effective and efficient. What we're trying to do is to use our platform to be an innovation platform. So, for instance, we've made an investment in an energy company that will hopefully be a a DC appliance company that will learn from sort of what has happened in the energy space in the last 5 years and be able to be a really strong B2B player. Our interest in that is because we do believe that sort of you need a different kind of financing product for energy. And we think pay-as-you-go is very interesting because what it helps you do ultimately is it helps sculpt payment to match income. And so, and And we had talked about savings. I'm throwing out a bunch of little things. Hopefully they'll all connect. But we talk about wanting to mobilize savings. We've also seen that when you go out and do like savings tents, where you encourage people to open savings accounts, they open the savings accounts, but they don't use them. One of the things that we're trying to pilot and experiment with is, well, look, pay-as-you-go is as much a communication channel as it is a payment channel. And so how do you use that communication channel to say, let's structure a 12-month pay-as-you-go product for a 10-month product, and then actually start creating savings for you guys. And then use that savings to say, now, gee, you've just created an emergency fund, or you've created a deposit fund for your next year's school fees. We're still working all of that out, but we do think that there is a role for us to play outside of simple access to finance, and it actually does involve partnering with, investing in, collaborating with the businesses that touch our customers, and that we believe touch us.
Yeah. Actually, just on that, on Finca, we've just signed this agreement, which is funny, where there is this partnership, right, in Congo through the MasterCard Foundation grant, so IFC, Finca, and we're working together on developing these digital networks. And it's a fascinating project because they're the largest, Finca DRC is the largest game in town in Congo, but you have literally, I think, 2% of the formal system have access to any bank account or formal services. So how can you leverage that 200, they already have about 200,000 people, clients, how do you leverage the 900,000 agents to develop digital solutions and use very simple technology, thumbprints, because there's a very low level of financial literacy, to really help change that market, right? To scale it up, and it's experiments like this which will really be then potential game changers in some of these countries where traditional solutions have not worked. So it's very interesting to see innovations like that take.
So this may be a question that's maybe for the next panel, maybe for the first panel, but I think also for you. My question is about what risks are being introduced by these additional products that have financing with them that may actually have lower interest rates than what the traditional microfinance organizations with their very large teams of loan officers and very high cost, very small loans have, which means they have to charge high interest rates. And we know that there are a lot of usury laws in various places. There's pressure when that interest rates are too high. Is there a risk that these new products coming in have lower interest rates and could be a competitive challenge just in terms of forcing microfinance organizations to have to start lowering interest rates to match them, either regulatory or competitive?
Yes. Jonathan and Bob Cull have recently done this work sort of documenting, trying to do a much better job of documenting the amount of subsidy in the industry. And bottom line is across the industry average, it's $26 per borrower per year. But that is an average with sort of wild variation in it. I think it's most interesting that the highest level of subsidy is for the largest commercial institutions. And that the lowest level of subsidy is for the nonprofit institutions. We can talk some more about that later if you want, but the point is that many institutions have done much better getting costs down over time. I think there's going to be additional pressure on that. I think one of the big concerns is where this competition comes from is from an industry that has no core that's pro-poor. So the fintech and the telecoms industry just don't care about poverty. They never have. It's not written into their founding documents. And we've had this transition in microfinance where there's a lot more for-profit, but there's still the core of it is the idea is you're trying to serve poor people. Vodafone just doesn't care about poor people. And so they are going to do whatever they need to maximize the number of people they're lending to at a profitable rate. And yeah, that could put a lot of pressure on a lot of microfinance institutions that do in fact care about poor people. And we end up with something that looks a lot more like the United States does, where you've got credit unions and savings and loans that have a community mission watching the people walk by on the way to the payday lender.
Yes, what I want to say is that your hypothesis, your assumption is wrong. It's not because technology can reach more clients that it reduce costs for them, because the cost is at risk. Because when you have 8 million clients that you don't know, then the product that you are serving to them, you don't know if they are going to pay or not pay. And in fact, the portfolio at risk of fintechs at the moment is quite high. Just that the number that they are reaching is so huge that even if there are 10%, 20% of a default, doesn't seem much to them. And so if you really look, they are not very transparent into what is really the interest rate. But if you really look at it, it's quite huge. So they are not bringing the interest rate down. They have a different business model. So I think competition is not on interest rate, but on other elements like rapidity of services. In 2 clicks, 3 minutes, you get your loan. And this, the client likes it very much, as opposed to, forming a group, sitting there for hours and listening to all these people telling them about financial education, health, and whatever. Clients don't like that. And clients don't like also what was the base of our industry, like the solidarity, the group pressure, and all this kind of thing. They prefer, confidentiality. You don't ask any favor to anyone. You just, get your $20 loan. You are not asking any favor to anyone. They like that kind of services. So what they are offering are on a totally different base than microfinance. And I feel that microfinance can also learn from what they are doing to improve our service to our clients, because clients now are not as desperate as they used to be 25 years ago. So they now tend to be able to choose. And now, what microfinance institutions are losing, and I agree with Timothy, what microfinance institutions are losing clients is not on interest rate, it's on services, the kind of services that they get, the rapidity, the confidentiality, all this kind of services that clients want. And so clients think, okay, this microfinance institution is not able to give me pre-approved loans in 3 minutes, then I will go to my cell phone and do that kind of transaction.
Yep. I mean, survey after survey shows that when you, interview clients, there are 3 things they want, which is like cheap, affordable, quality services at the minimum, in a very convenient way. And that's what these new service providers are able to do. I mean, you don't need to wait and go through group loan exercises and things. And that'll be the key, actually, for microfinance, the traditional providers, is how do you reduce your cost of operations and offer better services? And it's a thing for banks as well.
Goes to what Shannon was asking about, won't that introduce more risk?
So obviously the risks still remain, right? I mean, you're still lending to people who don't have collateral, may not have the cash flows to be able to support the repayment. And, if you're doing it digitally, you're one step removed.
Yeah.
And so even these digital providers have huge risks with, consumer over-indebtedness. A lot of them are unregulated, so, who knows what interest rates they're charging. And we're seeing that in several markets. And there is a lot of regulatory concern over stuff like that. So, I mean, it's not as if the risks will reduce over time.
Candace, did you have a question
I had
or a comment?
I think obviously there's more risk when there's a broader market, less client touch. That's a challenge to figure out how do you manage, as a business, how do you manage your risks in that environment? I think what's interesting to me is that fundamentally banking is a game of trust. trust with your client. And microfinance in particular has built a particular type of engagement with their client base in whatever evolution they have. So to me, the key is how do you maintain that trust and affiliation in a completely digital environment? Because that's really the core to maintaining a business that's based on connection to your client. And I think that's a big unknown.
And don't believe the technology companies when they tell you they know.
No, they don't know.
Of course they
don't know.
Right. No, and they don't have, I don't know how many of them actually use all the credit bureau information or how many have even covered under it, you know. It really depends in different markets.
And no technology solution is devoid of a human link, right? It's really, I mean, the issue that we work with our MFIs on is how do they combine the two differently, right? How do they add more value in the human side, right? And, you know, how do they address the cost challenges that they're facing by a rapidly changing industry?
Maybe another element to consider is beyond risk. It was mentioned that with higher risk, you can just compensate for that by charging a higher rate. So you have a higher write-off, but then, you know, it all washes out because you were charging a higher rate and it's still a good business. And that works from a financial perspective, but by writing off a higher percentage, you're actually not doing financial inclusion, but actually excluding individuals from the financial system, because those individuals would then be blacklisted and then not be able to get back into the system. So that's another angle to look at.
So thanks for the very unstructured conversation. I'm not a very good teacher or guider, but just to sort of summarize some of the points, and you can correct me, but it does sound like it comes down to the institution and its ability to move beyond just a traditional microfinance product and how it drives its mission and trains its staff and really thinks about that last mile distribution and product education and underwriting education. We didn't really talk about the technological innovation and how that may or may not help some of these institutions leapfrog, and hopefully we can touch on that in the next panel. But there's definitely room for microfinance institutions to play this role, but I do think that there is increasing competition from more specialty lenders touching the same base of customers. And so figuring out those partnerships on how they can link that knowledge base is critical. So whether it's the investor that's actually providing capital to these institutions to grow, or it's the NGOs that are providing information and data to help gather intelligence for this customer base, I think that's where there'll be some significant developments for the industry.